Hey guys, welcome to the next video in this series. We're reviewing my financial plan and information in preparation for starting my own business. We're going to kick off this video just where we left off in the last one. In the last video, we reviewed my profit and loss statements for the first 3 years projections of starting my business, and dovetailing into that, we're going to be reviewing the balance sheet for my business. Now, what is a balance sheet? Going over the format of that a little bit, a balance sheet shows the current net value of your business in any one particular point in time, right? So just as you see the cash balances and financial support or health of that business fluctuates quite periodically, that also reflects directly into the total net value of your business. If you were to go and try and sell your business, what is it worth? If you're going out there and trying to acquire a loan from a bank, what is your business worth? What do you have to leverage off of the value of that business? That's why your balance sheet matters here. So the format of this, it basically has two general categories. The first one being your assets, the second one being your liabilities. So your assets, what you own, what you acquired, versus what it is that you owe, what your liabilities are, equals the total net worth of your business. Now, there are different subsections to these two categories, and we're going to go through those right now. Starts with your short-term assets. And here I have identified my short terms are both cash and accounts receivable, right? So at the start, at the very beginning, I am yet to conduct business, but I have $20,000 in the bank to start this business, and that is my total cash value at the beginning. I have not yet done business, so I have no outstanding invoices I'm yet to collect on, which is an asset. Money that you're due is considered an asset. That's your AR. It's going to be shown here. So that's zero at the first year. But you'll notice that that changes throughout the years go. Now, if we go back to my second year's profit and loss statement, we will notice that the end of the year, from the cash balance of what it is that my net profit is infusing into this versus what my expenses are, I'm going to end the year with a total cash value of $66,213 on hand going into my third year. That is shown at the end of year 2 as my cash balance on my balance sheet. But for AR, I have $16,129, right? So that is my last year's. Did you see that in this category here? $16,129 is my accounts receivable. That is my last year's revenue invoiced for that I'm yet to collect on, because I have a 30-day pay cycle till I receive those funds. So my accounts receivable is shown here in that total value, and these years match what's shown on my P&L statements. That's why that matters. Now, following this, what else are your assets? You can also look at long-term assets. Now, that's usually equipment, right? That can be vehicles, that can be manufacturing equipment. If you're in the restaurant industry, you're going to have a lot of that with your food preparation and cooking and things and stuff of that nature. But basically, any business has a long-term asset. They have to. In my particular case, it's going to be computers. I'm going to be utilizing the ones that I own and have for my own personal use. Remember, during the start and even at the end of year 1, I don't yet have any employees. And I didn't purchase a computer. I'm going to be using my own computer to start this. I'm trying to keep all of my costs down so as not to expense any more than this $20,000 that I have, that I at least can afford to start this venture. But by year 2, I have employees. Employees, you have to provide that equipment for. So I'm being buying computers for them. By the end of year 3, not only do I have more employees, but I'm occupying a space now for my business. So I'm going to be acquiring printers and other equipment and more things of that like. So it's really office equipment in my particular case, but you're going to review what that is and would be for yours. Now, all equipment has a lifespan. Not everything lasts forever, and determining when it is that that equipment is going to be need to be replaced for a multitude of reasons, whether that's just wear and tear or new technology determines it to be basically archaic and inefficient anymore. You need to determine at what point it is that you're going to have to expense replacement of your existing equipment. And that is called depreciation, depreciated value. That shows in your business balance sheet, but it's also important it has tax implications on it as well. And why it is you're going to want to capture and catalog depreciated value of your equipment is because you're going to want to set funds aside in order to replace it when that time comes. You're showing that the value of that equipment is going from your original purchase price down to nothing. And that does impact your long-term assets. It is lowering in value there. But that's going to be happening in subsequent years. So this $300 you see here is only 10% of my $3,000 initial purchase price of computers and equipment in year 2 for my employees then. It cannot depreciate at that same point in time, so the following year it's depreciated 10%, which means that these computers are on a 10-year replacement cycle, depreciation maturity rate. Now, if this were to continue on to years 4, then you would see the continuation of the compounding rate of depreciation of my long-term assets down here. Now, when you look at the difference between these two values, I actually expensed an additional $9,500 in long-term asset equipment value in year 3. And the difference is, and the thing that I need to highlight down here is that your depreciation rate is shown down here in this column, but this value is subtracted from the current value of your long-term assets up here, so that they equal the same, right? So so the $9,500 additional expenses I accumulated with the $3,000 value, purchase price value from the prior year equals $12,500, and that is shown down here, but my depreciation is backed out of this number and demonstrated in this different row down here. And with all of these calculations on this, it shows the total asset value of my business at the end of each subsequent year. And what offsets that is my liability and capital for that year at the same time. So if I were to acquire a loan for this startup, I would have a note, right? That is it's a loan payment that you have that kind of hovers over your head. That's a liability. It's an outstanding liability that you have, and its total value would be shown up here. And then your payments for that would be offset to that. Because at any point in time, it's not just the payments you're making in the 12 months from any of these years that are demonstrated on your balance sheet that shows as a liability, right? It's the total balance you have remaining yet to pay off. So on your balance sheet, if you do have a loan, this long-term note amount would be slowly decreasing until you finally accumulate to the point that you actually have that paid off. And it's no longer showing as a liability over your head on here. Now, if you do have a loan, you should be generating substantially greater revenues than I am in my business in order to qualify to make the payments of that loan. So it wouldn't be as stark of a difference as it may sound if I were to add like $30,000, $50,000 to this. I would show quite a negative market value, total net value of my business within this. So the other things that are shown in your liabilities here is your owner's equity, right? Your startup owner's infusion. And this is where I could show and demonstrate, at least from a balance sheet perspective, if I were to continually have to invest more of my own money into this business for whatever reason that may be. If I identify a need to make a substantial investment that's going to be a large growth opportunity in the future, one that I didn't originally project, and I need to infuse another $5,000, $10,000, $15,000 into my business, that would be shown here. And why this is shown as a liability is that this is something that is due to the owner. This is something that recognizes their personal investment into this company. And this is one of the ways that you could identify what your break-even point is, right? Because if I have put in $20,000, the $20,000 itself being an asset to the business, but that is a liability to the owner, because that's something you're looking for a return on, right? Inevitably, you're looking to get at least that much out of it for your break-even. So that's a liability to the owner, to their market value of that $20,000, which at the starting point is the only thing that I have. A long-term note would be the only other thing that would feasibly be here at this point in time. Owner's additional capital infusion, which we've already talked about. If any numbers were in this particular line, it would be added to the owner's equity. That would be a return that they're looking for on that. And then you have a few other items that are here. Next is retained earnings, which is beginning of year. And you'll recognize this as the net profit line, right? So this is what it is that you've actually made on that. And this is beginning of year. And I want to separate that from the end of year identification of each one of these. I apologize, years that are individually identified. You can see the continuing compounding rate of depreciation of these long-term assets demonstrated in following years. Now, the total expenses that I've incurred on long-term assets, that being $3,000 within the second year and $9,500 in the third year, is a total of $12,500. And the reason I want to identify that is because you don't see $12,500 in the long-term technical equipment value that I have identified here. And that's because you're going to back out your depreciation in this. You want to be sure not to add those two numbers, right? This shouldn't show 12.5 with a depreciation of 300 because that shows you have a long-term asset value of $12,800. So you're going to have to back out your previous year's depreciation rate, add in the total purchase value of your current year's assets that you've acquired, and then show just the depreciate of your aging equipment's year's rate in that year to show your total long-term asset values within that. Now, the bottom line of this shows all of the asset value of what you have into your business, starting with your cash and then what you accumulate from thereafter. And the offset to this to determine the market or net value of your business are your liabilities. What it is that you owe in any capacity whatsoever is genuinely the worth of your company. Now, in case this is news to you, what you should identify is that your total liabilities plus your capital are going to equal the value of your assets. That is why this is called a balance sheet. There is something missing, there is something disproportionate and incorrect if this does not balance out to zero. Your liabilities and capital should always equal your asset value. And I'm going to give some explanation as to why that is. So long-term liability is going to be shown up here first. And this identifies a long-term note. I do not have a loan to start this business, but if I were to have one, that's a liability of mine. That's something I have to pay back, and it's long term, and it's the title to this. So the remaining balance of the loan that you have yet to pay off would be shown in this line here. So it should be decreasing in subsequent years as payments are made to that. Now the impact of making those payments is going to be shown in your cash value up here, right? Because it's going to be deducting out of that, offset by your long-term liability. The difference from this is my total liability. This is everything that I owe. That's first and foremost important to identify here on your balance sheet. Since I do not have a loan, I do not owe anything to anybody. I have no expenses projected, at least within the first 3 years of my operation, that I have to take anything on credit, payment terms, anything of that nature. I have a completely cash infused startup cost, and I have relatively low one-time expense purchases of equipment in the first 3 years via computer and printer and things of that nature that we've already discussed. So I don't actually have any liabilities. So the difference to that, how this is going to balance out, is the owner's equity. What does the owner have in terms of value into the business? Because that, in addition to your liabilities, should equal your total asset value. So at the beginning of this, when I have nothing, I have only put up the $20,000 in order to start this business. That's the only thing that's going to be shown here. At the end of year one, I still have a total personal value of $20,000 into the business. I have not infused any additional funds into the business. None were deemed necessary. If you do identify that you need some more money to make some kind of investment in whatever direction it is that may be to continue to grow and qualify your business in its marketplace, perhaps you need to put more of your money up in there perhaps you have to take out a loan in order to accomplish that. But those would be identified separately here. If it's your own money, it's your own equity that you're investing into the business. It's not something you owe to anybody else, but it is your equity in that business. You can see that I have not done that in either of the 3 years of operation that I have projected here. Your retained earnings is beginning of year amount. So that's from the end of the previous year. So you'll notice that current year's retained earnings, which is profit, this is your net profit line. And we're looking at the end of year one. So we show a value of $1,132 here of current year's retained earnings. And if we go to P&L year one, I have $1,132 of total profit generated in my first year. And that's what's demonstrated at the end of year one, right? End of year one. That carries over into the following year. Retained earnings beginning of the year follows from the previous year of that amount, and then you keep adding to this equity value the retained net profit earnings at the end of that year. And that continues to grow in each year. You'll notice this amount matches that amount because that's what we're following into. So we're just identifying what the growth is from each one of these from year to year as they go. Sorry, fixing some formatting issues here right now. So the total capital net worth amount is going to be these two numbers added up. Actually, I should say three numbers. I keep forgetting that because I don't have any total liabilities, right? No, I apologize. It is those two numbers. So this is your capital net worth. I start with $20,000 that I put up personally. That $20,000 made me an additional $1,132 personally within the first year. And you can see the growth rate to that. Now, your liabilities plus your total net worth is going to equal your liabilities and capital amount. And this should always equal your asset value. It cannot equal anything but your asset value. So this is how you identify, balancing this information is how you identify your liabilities, what you owe, how that is in ratio perspective relative to your total net worth within the business, and what the total value of that company is at that point in time based on all of that with your total liabilities and capital. And when you minus these two values, it should always equal 0, which it does because I have balanced this sheet correctly. Now, this is important information that a bank would also look at because just from a brief synopsis of this particular sheet, they can see if you are over or under leveraged based on what your liabilities are and how disproportionate that may be to either the net worth of your company or at least the short-term assets that you're generating for which you're going to be paying off that loan and things of that nature. So this is important information for you to identify the health and growth of your business, and it would equally be important and will be reviewed by any lending institution that you approach desiring their services in order to grow. Now, another sheet that I've used that is an integral part to how it is I've determined my revenue generated in each year and even price point and gross profit margin for each one is called the sheet itself is called service detail, and what's identified within this is unit cost and price detail. Okay, so I have my two different revenue streams that we've talked about already with my consultative service and my takeoff and development services. And as the years go, what I'm going to identify here is what my projected markup is on the labor and outside services. With yours might include material in this. Any sort of, you could have in-house labor, you could have outsourced labor, you can have material, everything that summarizes really in any of your P&L sheets, your cost of goods sold right here should be identified in your service detail sheet. So what is it costing you to produce your unit, whatever that may be? Again, minus time. I'm selling man hours. What does it cost you to get there? What is your sell price? This sheet just helps identify what is your total gross profit margin on that. And then you have to separate that out from what is the total revenue impact of that market that you're servicing on your total revenue generated company-wide. In this particular case, in the first year, I have nothing but outsourced services, right? No, I apologize. I don't have any employees. So everything I'm not doing myself is an outsourced service. And I have a 20% gross margin increase on that. And that is 68% of the revenues that I'm generating within that, which means 32% of the revenue I'm generating are hours that I'm producing myself, but I'm not paying myself anything. I'm not drawing a salary. So it costs me nothing for my own services. So I have a gross profit margin of 100% on that, but I can only do 32% of that. So 68% of this revenue stream is going to be outsourced, and I have a markup on that. But this entire revenue stream, consultative services, only accounts for 67% of my total revenue. The other 33% is from takeoff and development, right? And I have similar situation right here. I have the same resale price of $125 an hour. This is just giving you guys an idea of how to accomplish this. This isn't necessarily the true metric I'm going to be using for my own business. But let's assume it costs me $100 an hour in outsourced service in order to provide this service. I have a 20% markup on that, which is right? Product cost impact, I'm not expensing any of this myself, so 100% of that is being attributed to my outsourced service, of which I only have a 20% markup. 33% of my total revenue generated company-wide is produced by this, so I have a total company-wide gross margin impact generated from this revenue source of 6.55%. I have a total gross profit margin impact of 30.46% generated from my consultative services, which is 37% company-wide. And you'll see that I have a 37% gross profit margin identified in my first year if you look at my profit and loss statement for that year. This is all important to know so you can identify where it is your money is being made and how much it is that you're making. You can identify which of your revenue sources are in fact more profitable to you, and if you want to put more emphasis and focus on growing those particular markets, or if you need to offset that with different ones. But what does get so decisively different from my first to second year information is that by year 2, I now have employees, right? We've discussed that. You can see the impact of that in my second year profit and loss statement, but now you're going to see the impact of that on my unit cost detail. So now my labor no longer is free to myself because I'm employing people under my own house in order to do that for me. And I've identified a unit cost, a per hour unit cost of what my resale is of $46 to myself. And if I have a selling price still of $125, because whether I'm outsourcing that or providing that in-house, I have a unit sell price of $125. That gives me 64% gross profit margin on that. However, only 49% of what it is that I'm selling in my second year during the consultative services revenue source is coming from in-house labor. 51% of that is still being outsourced. And of that, this entire revenue stream is only 25% of my revenue generated. My gross revenue that's being generated is coming from consultative services. So taking that into consideration, I only have a company-wide gross margin impact of 10.5% to my business. Now, the in-house service that I have to provide, they can also meet the need for my second revenue source of takeoff and development for the employees that I have. So I kind of have the same situation here. But now, where I was exclusively outsourced in year 1, you can see that 100% of my product cost impact was coming from outsourced service. I have now turned the tides, and 100% of my product cost impact is now going to be done in-house. So this 64% gross profit margin that I have for my resale price of this service is going to be retained in-house, right? But only 75% of my gross revenue generated is coming from this takeoff and development service here. So I have a total company-wide gross margin impact of 47.32% of performing this service for the hours that I can sell at this gross profit rate. And if you add these two up, I have a 58% aggregate gross profit margin in my second year. And that matches what's demonstrated here in my second year profit and loss statement. So for the third year, I have some more investments that are being made in different categories. And still, I'm diversifying in my abilities and my 2 revenue sources that are identified. But I now have a total labor unit cost of $78, up from $46 from the previous year. Now, keep in mind that the entirety of my business expenses, at least that which is a direct cost of goods sold, right, everything that's associated with actually producing the sellable unit, which in my case is man hours, is incorporated into this. Part of that is now my salary. I'm paying myself. I'm intricately involved in developing this, but I'm no longer free to myself. So hence, that plus an additional employee and all of the overhead costs of their benefits and insurance and everything associated with that, it's increasing my unit cost, but it should amortize over the number of employees that I have. I would say that myself drawing my own salary is the largest impact that's demonstrated from years 2 to 3 now, because everything I was doing before was free. That's no longer the case. I'm now being paid for my service, where I was only paying one guy for the service of 2 in year 2. Now everybody's getting paid in year 3, hence the increase in the price. My selling price is still $125, and that equates out to a 38% gross profit margin on that unit cost, or unit sale price, I guess I should say. And I'm producing 77% of that service in-house, which is very good. I'm only outsourcing 23%. So this is the higher of the two profit margins I have on that. So still, everything I can do in-house only makes me more money than that which I have to outsource, which inevitably I'll still have to do nonetheless, but I'm anticipating a smaller percentage of that taking case in my consultative services revenue stream. I have increased my market share of this particular service from 25 to 29% of the total gross revenue generated for myself company wide, and that equates to, through all of this, 9.8% company-wide gross profit margin impact generated from this service that I'm providing. So takeoff and development, I have still maintained the ability to entirely provide this service in-house. That's 100% of that is being generated internally. I have no outside service costs actually equating into the unit cost of providing that service. I still have the $78 per man hour cost to produce of a resale rate of $125 of that. That equates to the 38% gross profit margin on exactly that. And of the 71% gross revenue impact from this service being provided, that is company-wide 26.54%. Add that with consultative services, I'm making 36% total gross profit margin in year 3, which matches here, and I am growing in those areas. We've talked about having the additional staff and employed and the expense of doing so in order to accomplish that, but I'm finally able to pay myself a salary, which is demonstrated within this, and I'm still maintaining healthy gross profit margins. Now you can see from this clearly my intent and my advantage to keeping this service in-house, right? You can see the lower of the gross profit margin I have from in-house services, from outside services, where I'm having to expense at least their time and labor to do that, and I only get the markup on it. I can control those costs better. I have higher profit margins in-house of that, and I'm wanting to turn the tides from years 1 to 3 of the disparity of how much of that I'm doing internally versus how much of that I'm outsourcing. Even in years 1, I'm outsourcing entirely takeoff and development. So I have put great emphasis into those areas in order to increase my total gross profit margin, of which I've accomplished doing so here. Now, if at this point in time, I'm going to segregate this information from any of the following videos. I would strongly encourage, if you have any questions about anything we've seen and reviewed today, that you please present those. Add those to the posting of these videos. I will try and get back to you and answer any of that I may have. If you have any comments for me to consider, I would very much appreciate that as well. As always, please do subscribe and stay tuned to the remaining information of the sheets that we're going to be reviewing in this workbook, which is the financial planning for the starting of my own business. Thank you.